The European Central Bank cut its rates by 25 basis points yesterday as expected, but killed all hope regarding a July rate cut as it revised its inflation forecast higher for this and for next year. Still, the week brought two rate cuts from two major central banks and plenty of soft jobs data from the US and, well, ended up being quite supportive of the reflation trade. So the US will be releasing its own official jobs data before the weekly close, before the Federal Reserve meets next week and is expected to reveal the latest dot plot. So welcome. This is Swissquote's Daily Market Talk. As widely expected, the ECB announced a 25 basis point rate cut yesterday, but the rest of the meeting and the ECB presser didn't go well for those. The ECB raised its inflation target, in fact, for this year and for next year, warned that the road for easing inflation could be bumpy, and ruled out a July rate cut. So the market no longer prices a full rate cut from the ECB by October. The ECB will remain data dependent and probably Fed dependent as well, without saying it aloud, of course, because look, even though cutting the interest rates before the Federal Reserve was not expected at the very start of this year, remember, and was, well, quite courageous, an excessive dovish stance from the European Central Bank could weigh on the euro's valuation and jeopardize the bank's efforts to fight inflation. So the European Central Bank's stance is quite clear. It wants to ease its policy, but it should be careful. As a result, well, the Eurozone yields jumped yesterday after the ECB decision, but the Stoxx 600 index hit a fresh record regardless, while the euro-dollar is flirting with the 109 level as every investor is now waiting for the US jobs data to either go long the euro-dollar or short the pair. Now, I will get to that discussion very shortly, but before that, I would like to say that, yes, the ECB didn't sound outright dovish this week. They sounded rather cautious regarding their inflation projections and their inflation expectations, and the ECB meeting wasn't necessarily conclusive. But at the end of the day, two G7 central banks still announced a 25 basis point rate cut this week, and that marked the beginning of the monetary policy easing cycle for the major central banks around the world, even though this easing won't be, well, fast enough. As a result, well, the S&P 500 reacted positively by hitting a fresh record yesterday. Sentiment in energy and metals around the world was cheery as well yesterday, as the reflation trade was supported following the Bank of Canada and the European Central Bank rate cuts this week, and also a better than expected Chinese export print. The British FTSE 100 index gained and US crude rebounded past the $75 per barrel level despite an unexpected build in US oil inventories last week, and could well settle between the $75 to $78 per barrel level, having seen a dip near the $72 support level earlier this week after the OPEC's announcement at the start of this week to start waning a supply cut policy from the third quarter of this year. Elsewhere, copper found support near its 50-day moving average, while iron ore recovered a part of last week's losses. So overall, again, I believe that this reflation environment should continue to give some more support to the energy and mining heavy markets as the major central banks around the world will step concretely into the monetary policy easing phase, and that again regardless of how cautious they are and how fast the interest rates will be pulled lower. We know that it will all depend on inflation. Now, looking at the currency markets, the more hawkish than expected European Central Bank stance yesterday regarding the future interest rate cuts is obviously supportive of a further rebound in the eurodollar, and I now revise my eurodollar outlook to neutral from bearish before the meeting, because look, the ECB remains in a better position still to cut its interest rates later this year and should actually proceed with one more interest rate cut at least before this year ends. However, the euro area's surprise index actually improves, hinting that although the expectations regarding the euro area's economic performance remains quite soft, they do improve. And the Eurozone is expected to revise its first quarter GDP growth data from none, 0% to 0.3% today. Whereas, on the other hand, the US data surprises to the downside, with the US Economic Surprise Index printing the most disappointing level since 2019. And also, Atlanta Fed's GDP Now index rebounded past the 2% level this week, but it looks quite choppy right now. So the fast deterioration in US outlook and the slightly improving Eurozone economic outlook actually narrow the gap between the hawkish Federal Reserve and the dovish ECB expectations, and the latter could actually throw a floor under the euro dollar at the wake of the first European Central Bank rate cut. Now today, all eyes turn toward the US jobs data. The week was marked by, softer than expected job openings data in April, a significantly lower than expected ADP report for May, a surprise decline in the pace of unit labor costs in the US from 4.7 to 4%, and also an unexpected jump in weekly jobless claims in the US as well. And the consensus of analyst estimates on a Bloomberg survey actually bets that the US economy may have added around 180,000 new non-farm jobs last month. The unemployment rate in the US is seen steady near the 3.9% level, and wages growth in the US may have slightly accelerated on a monthly basis. So those are the expectations. A soft jobs report from the US should support the dovish Fed expectations and further weigh on the US dollar after the data. The US dollar index remains sold at the 100 and 200-day moving average area this week and has potential to decline with a soft set of data before next week's FOMC meeting. Now, regarding that meeting, whatever today's jobs data says, the Fed isn't really expected to cut its interest rates when it meets next week, to be honest. So the Fed members sounded very cautious, remember, regarding their inflation expectations for the rest of the year. Therefore, the new dot plot from the Fed will probably show 1 or maximum 2 rate cuts on average this year, and that would be down from 3 rate cuts expected at the start of this year at the latest dot plot. But that's mostly expected and that's mostly priced in and could be the peak hawkishness for the Fed this year if the economic data in the US continues to disappoint and weaken. Elsewhere, complete different subject. Nvidia is after hitting a fresh all-time high level yesterday, and Microsoft consolidated gains above the $420 per share on news that the US opened antitrust investigations into 2 of the world's now most valuable companies due to their dominance in the rapidly emerging field of AI. Nvidia, for example, was accused by the FTC to sell its chips to customers that are most likely to use them quickly. And Meta, Amazon, and Alphabet, these 3 stand for about 1/3 of Nvidia's revenue. But note that these antitrust investigations against the big technology companies are very common indeed, and they have not really prevented their stock prices from rising thoroughly in the past. So I don't see a major issue here, to be honest. In fun news, GameStop soared 47% yesterday as Roaring Kitty announced a $382 million gains thanks to all of those people who helped pushing the stock price higher this week. But given the fact that the price rally that we see in the GameStop shares has no fundamental support at all, the spikes could actually be interesting opportunities to short the stock before the company reveals its first quarter earnings. They are due to arrive next week, where it is expected to announce a negative 10 cents EPS growth, by the way. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.